If you're starting to invest in 2026 or even just thinking about the idea, stop, because there is one mistake everybody in their 20s makes that could cost you years of growth and valuable time. I know this because I've made it, and people around me say the exact same things every time we talk about investing in person. When I first started investing at 23, I had this massive sense of imposter syndrome because I thought investing was reserved for this elite community of finance bros, investment bankers, and essentially rich old people, right? People in their 40s who are settling down. I thought investing was reserved for that side of the community, but I was completely wrong. That one fundamental belief set me back, and I didn't even realize it at the time. I'm 25 now, and with the knowledge and different experiences that I've picked up throughout my early investing years, I'd have probably started investing straight away on my 18th birthday. I would have opened up an ISA account and I would have got things going. But hindsight is 2020. At the end of the day, we can only focus on what we're doing today in the know-how in the present day, and that's the mindset shift that has supported me. And here's the crazy part: you don't even need a lot of money to start. You already have the best advantage anyone can have, and that's time. And if you're in your early 20s, or even if you're in your early 30s, you have the best part of that right now. So if you're watching this video, you're already on the right path. I'll show you exactly what I would do if I had started investing this year in 2026, including the one decision that I made earlier that would have changed everything within my investing journey. So if investing has even crossed your mind this year or last year, and you're willing to kick it off now, and you're serious about leveling up this year in 2026, watch until the end, as I'm confident you'll unpack some relevant gems that will support you on your growth too. In today's video, we'll be talking about fundamentals of long-term investing for anyone in their 20s, where to invest into stocks and shares through an ISA, how much to invest, how to pay as low fees as possible, and choosing the right account that is obviously FCA regulated. It's important to keep investing as simple and as routine as possible. Think of it like brushing your teeth or going to the gym. Find a routine, any routine that works specifically for you and something that you can stick to consistently. For example, for me, and this is not financial advice, I'm only sharing my opinion and what has worked for me, is I allocate a percentage of my income to invest in, and that is dedicated for investing. So in my mind, psychologically, it's already written off. I know where that money is going, and that makes everything a lot more easier because it's within my life, it's within my routine, it's something that is just done for me. This is why the bulk of my portfolio is comprised of ETFs. They act as the sun of my portfolio, mainly for a diversification perspective. For example, I invest in the S&P 500, which track 500 of the largest companies based in the US. However, as of late 2025, the index is heavily dominated by players such as Nvidia, Microsoft, Alphabet, Apple, and that nearly accounts to 30% of the overall index. This is almost known as concentration risk because the index is so focused on a select few companies that are driving majority of returns. Now, the S&P 500 committee does still meet on a monthly basis to discuss revisions of companies in the S&P 500. For example, they could discuss whether to add companies into the index or remove companies, and this is based on several factors such as market cap, liquidity, and overall profitability of these companies. Now, they meet on a quarterly cadence to put these changes in place, so they could add a company or remove a company, but it's not that noticeable. Now, I think it will become more noticeable, obviously, if a company like SpaceX or a company like OpenAI decide to IPO, which I think they could. There will obviously be much larger changes and provide a lot more liquidity into the ecosystem. Now, what I've done to mitigate some of this risk is to start investing in an all-world ETF. So I have capital invested into different regions and different companies around the world, all the way from emerging markets to developed world as well, across Europe, Asia, and obviously the Middle East. There's some diversification there as well, and in the US too. Now, when I first started investing, it was very tempting to buy loads of stocks because you see what's going up or down essentially, and you perceive that as value. When now I don't even really look at the share price because it doesn't actually show you how well the company's doing. It's only a price. I do a lot more fundamental analysis, and I invest in ETFs that have a diversification of companies within it, so I'm not solely reliant on the concentration risk of investing into one company across one industry, for example. Now, of course, you'll need an investing platform to start investing, and if you're a UK taxpayer, you'll have up to £20,000 that resets every April to invest within your ISA. Now, as this channel is mainly focused on stocks and shares, I will be focused on that other than the lifetime ISA and the cash ISA. But if you wanted a detailed video on ISAs, let me know down below and I can share how you can leverage each ISA successfully. Now, for me, I use Trading 212 for a couple of different reasons. Firstly, the user interface is great. It's very easy to use and get started. Creating an account as well isn't rocket science as long as you follow the steps on the Trading 212 page, but I can create a video and a breakdown of how to set up your account correctly. And it's commission free. Investing in these products, you don't have to pay commissions. Of course, if you're purchasing a stock based out in the US, there'll be a slight FX fee you have to pay, but nothing is so significant. And that's the main thing with investing. You want to keep the fees, for example, as low as you can, and Trading 212 does a great job of doing that. Now, there are different platforms out there that you can use. I have a general investing account as well on FreeTrade, and there's larger companies you can leverage such as HL, Hargreaves Lansdown. In my eyes, that platform didn't work too well for me just because of mainly the user interface. Everything seemed a little bit dated for the platform that I wanted, but as long as the platform is FCA regulated, then it's a platform that can be trusted, because you don't want to invest in any platform that isn't regulated by the FCA, so you have a bit of protection for your money as well. But take the time to look at the platform, take the time to really look at the terms as well. If you're going to invest for the long term, you want to ensure that your money is protected for the long term too. Now, something that is so overlooked, and the one decision that I wish I made earlier on in my investing journey, is understanding how much I'm willing to commit to investing and having a set amount to invest each month, or it could be quarterly, for example, whether it's a percentage of your earnings or a flat amount that you've dedicated to investing. This will take out any guesswork that you have when it comes to buying an ETF or a stock on that monthly, or it could be monthly, weekly or quarterly cadence when you decide to invest. I used to get in my own head and think, am I investing too much or am I investing too little? It just caused a lot of chaos in my head and there was no clarity there. But what I found is investing little and often consistently is the best way. It allows you to sleep at night. You don't have to think about whether you have to invest more or less, and you already know that it's within your plan, so you're already on track to do the right thing. Now, don't get me wrong, I also keep some cash set aside just in case we have a slight correction in the market, and I'll be willing to buy more ETFs or stocks that I have an interest in. But this isn't my main strategy. I don't just sit and wait to time the market, because nobody can time the market. It's something I see as a bonus, and I just want to have spare cash aside to take advantage of opportunities if and when they come. I like to see it as a time to be aggressive when opportunities present themselves. And if you're buying multiple stocks and ETFs, you'll obviously rack up fees that just naturally come with it. Now, when you're investing in a fund, typically you'll pay an ongoing charge fee, a transaction fee, an FX fee, and understanding fees that come with investing are so important, because the lower the fees are, the more money you keep for yourself and the investments. Essentially, less fees mean more compounding for your account. Now, starting is often the biggest hurdle when it comes to anything in life, and specifically with investing, because you're putting your hard-earned money to work essentially, and it could be something that could be seen as a little bit uncomfortable. So starting with something that's comfortable for yourself and just getting started is often the best way to get your feet wet in the water. You don't have to be a millionaire or start with thousands to invest. The best way is to start, like I said, little and often, and set an amount that you're comfortable with each and every month consistently. Now, thank you for watching the video, guys. If you did find this helpful, let me know in the comments below, and let me know if you're also starting investing this year. I'll see you on the next one.